Welcome to By the Books, the podcast helping business owners navigate the complex world of business, tax, and bookkeeping. Now, to the owner and president of Kline, Lindsay Kline.
Thanks for joining us, everyone. This is Lindsay Kline with Kline, honest, accurate bookkeeping performed on time, and your host of By the Books. I'm here today with Chris Gross of Frito Nation Productions. Thanks for joining me again.
I am so happy to be here, and especially because we've got food laid out here. For those who are listening on the podcast, if you check us out on YouTube, you'll see that we've got it looks like we're going to eat snacks today. Is that what we're doing?
I'm not going to eat them. I'm being good. I'm still doing keto.
Oh, that's right.
But you feel free because we have lots of M&Ms here. If you are watching on YouTube, then you can see we have some peanut and regular M&Ms and different colors that I have divided them up into. So, yes, I'm trying to come up with an interesting way to explain accounting. So what better way than with M&M candies?
I couldn't think of a better way, honestly. So this works for me.
Now, your dad's a CPA.
Yes.
Has he ever tried to explain accounting to you?
Not so much. I think it really the only time we get into any talk about that is around tax time, because I've mentioned on the podcast before, any kind of talk about that we do when he's helping me with my taxes.
Okay. And he just decided this was a hopeless case and no, I'm kidding.
Honestly, I will say the one thing was I don't know if made is the right word. He strongly encouraged me to take an accounting class when I was in high school.
How did that go?
Actually, the class was really good. It had nothing to do with the class itself. That is actually how I met he was a foreign exchange student from Germany.
Okay.
And so he was living in the United States for that year, and I'm still friends with him, and we'll do like FaceTime chats.
Okay.
So,
but did you learn any accounting?
Not that I remember.
Okay.
I will say there are things, and we've talked about it before. I know we're going to get into it. The equation is your credits equal...
Yes, tell me, Chris. What do your credits equal?
Credits equal your... No, that's not right. There's assets and debits in there somewhere. That's all I know. I know there's three things, and that's two of the three, right? Am I right?
Are you talking about the accounting equation?
Probably.
Assets equal liabilities plus equity.
Okay. So I wasn't right at all. That is.
But debits have to equal credits. So maybe that's what you're thinking of.
So now I'm being rushed back. I'm thinking of the test of now I've got to make the two things equal on either. Like, I'm not kidding. Like when you said the debits have to equal credits, I was just like thrown back into my accounting class. So I will say every once in a while I get things that come back from it, and it wasn't my teacher's fault. I think it was me just not retaining any information.
So I actually have two cups here that are empty, and I don't know if we can see them on the video, but they're clear cups and they represent debits and credits, which always have to equal. And the regular M&Ms are going to represent our debits.
Okay.
And the peanut M&Ms are going to represent our credits.
Okay.
So that's what all this is. So you're right. Debits have to equal credits.
Okay.
So
I know that.
To give us some context for this episode, though, I kind of teased a little bit in the last episode that you and I recorded together. I told some stories that I probably shouldn't have told about some difficult people I'd worked with.
Yes.
Clients and employees. But hey, I went for it. It's all out there. But there was one conversation that had with not a prospective client, who was actually a client, an attorney, was trying to tell me that the way we had booked something was incorrect, in his opinion. He didn't like the way it was being handled on the bookkeeping side. And so I'm trying to explain to him why I felt it was not done incorrectly and explain to him why we did it the way we did it.
Okay.
He was getting very exasperated and telling me that his wife had all of this experience, which I think her experience was more like finance, which is different from accounting. But he kept telling me how she had all this experience.
Yeah.
And so I, and that she thought it didn't need to be booked this way either. So both of them together had decided we were doing it wrong. And so then I decided, rather than trying to explain it to him, I would just try to figure out how he wanted to do it instead. Like, why don't we try it that way? So I asked him, and he said, okay, well, how would you like it to be done? Let me just understand the way you wanted to see it, right? And he was getting exasperated. Well, I'm not an accountant. I don't do that. So all he wanted to say was that it's wrong, but he did not have a solution to it.
Okay.
And so he told me, he said, my wife says you just need to do a journal entry to fix it.
Okay.
So I'm sure being a non-accountant, that means nothing to you.
That is correct.
But the accountants out there probably already think this is funny because we understand that is not helpful whatsoever. And let me explain to you why. I'll try to explain it to someone that's not an accountant.
Okay.
All right. Let's say you're making a recipe in the kitchen. All right. You've got the recipe and it usually tells you everything you need.
Yeah, right.
Right. Your list of ingredients. That you're going to need a whisk and a, measuring cup or whatever, right? You've got your list of items you need for the ingredients and the items you need to actually do it, right?
Yeah.
Okay. So basically the equivalency, if he's trying to tell me you're doing the recipe wrong, you should not be doing it this way. And you say, okay, how would you like me to do the recipe instead? You don't like the way I'm making it. How would you like me to do it? Just use a spatula. Just use a spatula. Okay, I can use a spatula, but what would you like me to do with the spatula?
Okay.
And what would you like me to mix with the spatula? What do you want me to do with it? Right. So that's the kind of the equivalency, because journal entry is just a type of transaction. And from a person that doesn't understand accounting, the accountants know literally everything you do in accounting is a journal entry.
Okay.
Now that gets blurred because a lot of people are used to seeing QuickBooks or something similar, and QuickBooks tries to make it very user friendly. So you have all the little icons that might say check or deposit or whatever, and you click it, and it, if you click check, it opens up and it actually looks like a check, and it has payee and amount and date and write that, right? What QuickBooks is doing behind the scenes, when you're entering it in, it looks like a check, but behind the scenes, QuickBooks is doing a journal entry.
Okay.
Literally everything in accounting is a journal entry. Okay. So it's like, in baking, you always use the oven. So it's almost like him saying, just use an oven. Just use an oven. We always use the oven to bake. That's how we bake, is in an oven. Yes. That doesn't help me. What are we putting in the oven?
Okay.
What are we mixing together? What ingredients are we putting in there?
Yeah.
Yes, we're using an oven for sure.
Right.
We always do. What do you want in it? So that's kind of the equivalency of how helpful that advice was. So I'm like trying to say, okay, I said, okay, let's do that. Let's do a journal entry. So I open up a journal entry in QuickBooks and say, okay, I have the journal entry open. I'm ready to prepare your journal entry.
Okay.
What do you want me to put in the journal entry? So, he kept saying, well, I'm not an accountant.
Yeah.
I don't know. This is your job.
He's not an accountant, but he knows
that it's
you're doing it wrong.
Wrong, right. And then he proceeds to tell me how great his own personal bookkeeper was.
Okay.
And the irony there, because he had his own company and we were doing the books for his partnership. Okay. So he had his own bookkeeper that handled his company. And he proceeds to tell me how much better she was. And the irony of the situation is that I had already been communicating with her and had asked her about this specific situation prior to having the conversation with him. And she had agreed with me that we were handling it in the best possible way. So her and I had already had that conversation. So he starts telling me how much better this bookkeeper is. And I said, well, actually, I've talked to her about this situation and she agreed this is how we should handle. Well, she just doesn't understand the situation. Okay. You're the owner. I will handle it however you want to handle it. Just let me know what you'd like me to do. Right? So eventually he kind of muddled through what he wanted me to do instead. And I didn't tell him this, but ultimately the end result did not change anything. In his mind, it was different, but in reality, nothing changed. So this was my inspiration for this, because had he had some understanding of accounting principles, he would have known there's really, first of all, only 3 buckets. And that's why I have 3 colors here. I have orange, green, and blue. There's only 3 buckets that we can put things. And oftentimes, even though you might be switching from one account to another in accounting, you're just moving it from an orange M&M to an orange M&M, and there's no change.
Okay.
I mean, it's in a different place on your report, but the end result, net zero difference.
Okay.
So that is the context for why I got the inspiration for this episode.
For the M&Ms, learning accounting through M&Ms.
Okay. So, you know, they're called debits and credits, and they always have to be the same. Like, if you've ever heard balancing the books, have you heard that expression?
Yes. Yeah.
That's what it means, that your debits equal the credits.
Okay.
Now, who had the not brilliant idea to call it debits and credits? Because all that has done is confused generations of prospective and frustrated accounting students, because it makes no sense.
It does not. No, it doesn't.
It does not. I can remember being young 20s. I was probably, 21 to 23 years old, and my very first accounting job as like an accounting clerk, low on the totem pole.
Yeah.
You know, I understood how to get to things in QuickBooks. I did not understand the journal entry principle, right? And so my boss, bless his heart, is trying to explain credits and debits to me, and I was so confused.
Yeah.
I did not understand, if I want to increase my bank balance, why would I be debiting it? That makes no sense.
Yeah.
Okay.
Yeah.
So this is my inspiration for the M&Ms. We have got to stop thinking in terms of debits and credits. It's stupid.
Yes.
Just say that's stupid. Instead, we're going to say peanut and regular.
Peanut and regular. Okay.
That's it.
So we're not going to say no more debits and credits.
No more debits and credits.
Yes. Here we go.
Yeah.
We've got our regular M&Ms here.
Yes. And our peanut M&Ms here.
Yes.
Okay. So credits are now peanut M&Ms. Debits are regular M&Ms. Okay.
All right.
So we can just take away the confusing aspect of debits and credits, because it makes no sense. Because in accounting, you debit a bank account to increase it. It makes no sense. So just don't even let that confuse you.
All right.
All we need to know is that regular M&Ms have to equal peanut M&Ms.
Okay.
They have to always be the same.
Yeah.
That's how we keep our books balanced, having the same. There can be no one over the other. They always have to balance, always the same number. Okay. So if we put one in the regular, we have to put one in the peanut.
Okay.
It just always has to be the same.
Yes.
Okay. Now we have orange, we have green, we have blue. These represent 3 different things, which we talked about earlier, is our accounting equation. Remember assets? That's green.
Okay.
Green is assets. Then we have orange. That's our liabilities. Blue is our equity. So assets equal liability plus equity.
Okay.
So, and you notice there's a lot of green in here.
Yeah.
For some reason, there's more green M&Ms than anything.
That is an interesting part of this. That
we're learning multiple things through this process.
Yeah.
So we have a lot of assets sitting here. You can see they do not equal. Well, they might. I guess if you put these 2 together, they might actually equal the green. So assets.
Okay, well, you have 2 peanuts here. Do I need the green peanuts also?
No, they're all mixed up.
Okay.
I just put the reason I pulled these is because I put on the cup
All
what
right.
they are so that I
Gotcha,
could
gotcha.
remember which color is which. Okay. So don't worry about the peanut and regular right now. Right now we're just talking about the accounting equation. Assets, which is green, equals liabilities plus equity, which is orange and blue.
Gotcha.
Okay.
Yes.
All right. So that's the accounting equation. Everything goes into these 3 buckets. No matter what you're doing in accounting, they go in these 3 buckets. These 3 only, no matter what you're doing. We have different kind of assets, right? So assets could be cash. So it could be a bank account, could be petty cash, could be a car,
House.
a vehicle, could be a property. Yeah. Could be land. It could be a building. It could be a fixed asset. So it could be equipment. These are things you own. So that's green. Everything you own could be tangible, could be intangible. Sometimes it's intangible stuff. Maybe it's intellectual property.
Yes.
Anything you own that's an asset. So that's green.
Okay.
And that equals these 2 things together, which is your liabilities and equity. Liabilities could be a credit card, could be a loan, business loan. It could be a line of credit. I'm trying to think of other types of
Liabilities are things that
you owe.
count it. Yes. Like they're negatives against you.
Well, it's debt. A debt can be used in a positive way in business, but yes, it's debt.
Okay.
Yeah, that's everything you owe. And that could be something you owe to a bank. It could be a credit card. It could be something you owe to a individual person.
Sure.
It's just a liability, something you owe. It might be a tax liability, something you owe the IRS.
Okay. Student loan, something like that.
On the personal side, yes. That wouldn't be on your business books. But yes.
Okay.
So
Yes.
anything you owe. All right. Then equity. That's what's left. So if you think of, we've talked about this analogy before, your home equity in your home, right? You have the asset, the green M&Ms. That's the actual home, right? That is the property.
Okay.
That's the house, the land, everything that's the tangible property, right? And you can increase the value of that by improving the home, right?
Yes.
That's the green. So the green, which is the asset, equals the liability, which is the loan on that property. That's the mortgage on that property, what you owe the bank for that property. And what's left is your equity.
Okay.
And so if you think of it in those terms, the equity in your home, right? That's if you were to sell your house, sell the property and pay off the mortgage, that's what's left is your equity.
So let's say I've got a $300,000 house.
The value of it, you mean?
The value.
Okay.
There's let's just say I've got 100,000 left on my mortgage.
Okay.
So that means the equity is 200,000.
Yes.
Okay.
Yes. Same thing in business. So when you're talking about the accounting equation, assets equal liabilities plus equity. Same with your house.
Yeah.
So that's the accounting equation. So green equals orange plus blue.
Gotcha.
All right. So that's our accounting equation. Everything we do in accounting goes in these 3 buckets. Everything. No matter what.
No miscellaneous
There
that
is
can
nothing.
be stuck anywhere else.
No.
Okay.
All 3 of them.
Yeah.
So
Gotcha.
Yes.
Gotcha.
Everything goes in these 3 buckets. There's no exceptions. Okay. So now how do we incorporate these 3 colors into the peanut and regular that
I have
always
no
have to
idea.
balance? So let's start a company.
Okay.
What kind of company should we start?
We sell cotton candy.
Okay, we sell cotton candy. We obviously did not get advice prior to starting this.
No, this is really good cotton candy.
Okay,
like
really super good.
It's
cotton
the world's
candy.
best cotton candy. Yes.
Okay, and there's this much market for cotton candy
There
that
is.
we can. Okay,
because it's so good. We're
Okay.
putting everybody else who sells cotton candy out of business. That's how good our cotton candy
all
is.
right. So we have our cotton candy business we're starting.
Yes.
But we have nothing right now, right?
Okay,
See how the cups are empty. The business has nothing yet. We've just had the idea. Now we need to actually get started. So in order to buy our I don't even know how you make cotton candy, but I assume we have to have
sugar and something.
So we got to have ingredients.
Yes.
Okay. And I assume we have to have some kind of machine or equipment of some sort, right? So how are we going to buy all this? We're probably going to have to either loan ourselves money, like put our own money in, or go get a loan. So what are we going to do?
Can we do both? We'll do...
Okay. Sure, we can do that.
Okay.
All right. So let's say you and I, we're going in together.
Yeah.
We decide, okay, we're going to put some of our own personal savings into the business to get it started. Okay.
Okay.
So we drop in, I don't know, $5,000 of our own money into the business.
Okay.
All right. So now we have our first business transaction that now we need to record in our accounting system. Okay.
Okay.
So what's happened? Our cash has increased by $5,000.
$5,000.
Right.
Okay.
So that's an asset.
Yes.
Green. So we'll just say one of these represents
$1,000.
$1,000. So I'll put 5 in there. These are regular M&Ms, which is our debits. Now, remember, in accounting, debit
Has to equal credits.
yes, but debits increase your bank account. So this is why we're calling them regular. We're putting 5 regular M&Ms in there to represent the $5,000 cash that we now have. So we have 5 regular M&Ms, but we have nothing right now in our peanuts. So we've got to have the equation. We have to equal, right?
Right.
Okay. So how do we make this equal now? Because what are our 5 peanut M&Ms?
What are they?
Yeah. What is it? Any ideas?
I have no idea.
Okay, well, we're making a contribution into our company, which is equity. This is our owner's equity. We have actually increased our equity by $5,000. This is our owner's equity, basically what's left over after our liabilities are paid. Now, some people, when they contribute to their company, there are certain circumstances, usually tax things, where it'll be recorded as a loan instead. So it would actually be a liability when the owner contributes.
Okay.
We had that situation come up, if you remember the episode. What do we call that episode about that question that every CPA answers differently?
Right.
There was a situation there where the CPAs wanted to record a contribution actually as a loan. So sometimes it does happen that way. But for our purposes, it's a contribution, and that's equity. We're actually increasing our equity. So I'm putting 5 peanut M&Ms in there. So now we're balanced again. We have 5 regular. We have 5 peanut. We're equal. Okay.
So our books are good.
Our books are good. They're balanced.
All right.
So now, what are we doing next? We've got our $5,000 in.
So now to get the rest of our equipment, we've got to get a loan.
Okay. All right. So we get, let's say, an SBA loan to get some more funding.
Okay.
All right. So now we have this loan. They put the cash in our bank. We got a nice deposit from the SBA. Now, what do we do?
Okay. So that's a liability.
It is a
'Cause it's a
liability.
loan.
So yes, just for the sake of ease, we're going to say it's also $5,000. And that's peanuts. We're increasing our liabilities. That's peanuts. So I just put 5. Now we have 10 in peanut M&Ms, but we only have 5. I mean, we have 10 peanuts. We have 5 regular.
So why did the loan go into the credits?
Because you increased a liability. When you increase a liability, it's a credit.
Okay. All right.
So the flip side of that is a debit, which is increasing our cash.
So that's an asset.
It's an asset, right? We increased our cash just like we did before. So that's still green.
So 5 more green regular M&Ms.
So now we have 10 regular M&Ms, which represents the $10,000 in our bank account.
Yes.
So our assets have increased by $10,000. On the other side, we have 10 peanut M&Ms, but they're 2 different colors. Our equity increased by $5,000. Our liabilities increased by $5,000.
Yes.
And in our accounting equation, remember, assets equal these 2.
Right. So we're good.
We're good.
We're good.
Our books are balanced. All right. So now what? We've got our money. We've got $10,000 in the bank. What are we doing?
We probably need to buy some equipment.
Okay. So give me an amount. How much is our equipment? Do it in equation in thousands so that I don't have to do it.
Let's say it costs us $2,000.
Okay.
For our equipment.
Okay. So we're buying a piece of equipment.
So we're gonna lose $2,000.
Yes.
In cash. So I'm taking these out.
So take your 2,000 out. You're lowering your liability or your assets.
Okay. So now we're down to 8 M&Ms here. We got to get down to 8 M&Ms here.
Do we?
Yes, because
what's the flip side of that? Your cash decreased by 2,000.
So
now
our
what?
equity would decrease by 2,000.
Are you sure? What else is happening there? You paid cash, and what did you get in return?
Oh, we gained equity.
We gained
we gained assets.
We gained an asset. Now, typically the asset threshold is 2,500, but we don't have 500s because our M&Ms.
Yeah,
we didn't
cut any in half.
Let's just say it's 3,000.
Okay.
Okay, we paid 3,000 cash because usually under 2,500 you don't put it on your fixed assets.
Okay.
You expense it, but we're gonna say it's 3,000, so we don't have that issue. All right, so we paid $3,000 cash.
Yeah.
What did we gain in return?
$3,000 worth of equipment.
Okay.
Which would be $3,000 worth of assets.
Yes.
So then I'm putting 3 green M&Ms back
in there. So what we did is just exchanged one asset for another asset.
Okay.
Okay. So this goes, back to what I was saying earlier, where you can have a transaction that goes from one account to another, but the effect
is nothing.
On the books is essentially the same. Yes, you have it in a different place, and obviously there's different tax ramifications, but the end result here is the same. We still have 10 green M&Ms.
Okay.
Does that make sense?
Yes, I got it now. I got it now.
Sometimes you're balancing by just reducing the same color and then adding the same color of a different kind, right? Okay. So
I have a question.
Uh-huh.
So assets will always be a debit?
If you're increasing the asset.
Okay. And liabilities and equity will always be a credit?
It depends on which direction you're going. So a bank account, you put money in, you take money out.
Right.
Okay.
Okay.
So if you're taking money out of your bank account, if you purchase something, that's a peanut. It's a credit.
Okay. Yes.
So actually, probably what we should have done to be consistent here, when we did the $3,000, we should have done 3 peanut M&Ms and 3 regular M&Ms. That would have been a better way to do that.
Why? Explain that to me.
Because you have to credit the bank account to reduce it in accounting. Makes no sense, right? So
it makes no sense.
It makes no sense.
Yes.
I get it. It makes no sense. That's why we weren't calling it debits and credits.
Right.
We had to put 3 peanut M&Ms to take it out of the bank account.
Okay.
Which it's counterintuitive, right? Because you feel like you need to take something out of the cup.
Yeah. Right.
Yeah. I get it.
Okay.
But actually what you're doing is reducing the balance by crediting it, by doing the peanut M&Ms.
Yeah. Can we I'd love, now I'm at the point where if I ever got a time machine and I could go one place, I would go back to the guy who named debits and credits, and I would make him call them something else.
I get it. This is why I say it just makes it so much more confusing than it has to be.
Right.
But yeah, all you're doing is this equals this, whatever you want to call it. You want to call it M&Ms, you want to call it teddy bears and rabbits. It doesn't matter. Yeah. They just have to be the same. I know, it's very confusing. By calling it debits and credits, we have already in our head what a debit means. You're reducing, right? Debit means reducing. Right. In accounting, that's not true. And here's what gets more confusing is sometimes in accounting, debit means reducing. Sometimes it means increasing. So that's why you can't see it as always going one way or the other.
So I need to, basically in accounting, you have to, what are common vernacular definition of debit and credit are. You basically got to throw that out the window.
You got to throw it out the window. This is why it should have never been called debits and credits.
Yeah.
And it's not helpful in any way to call it that way. So literally call it something else in your head. When you're debits, whatever word you want to use.
So debits are regular and credits are peanuts.
Yes, exactly.
There we go. Okay.
Yes, they just have to equal. All right. So we have our equipment now. Now what do we need to do?
I think let's hire some employees.
Oh, great. Right off the bat, huh? We have no income yet.
Okay, then we've got to... So I guess you're right. You and me are going to be making these first couple batches of cotton candy. I would say
we are.
Okay. All right. So let's say we've got some product.
Okay.
That we're ready to sell.
Well, we have to have ingredients first, I would imagine, right? We got to go buy the sugar and the whatever.
I don't know.
How do you make cotton candy?
I don't even know.
Okay, well, definitely sugar. We know that. So we got to go buy all our sugar. And I don't know, food coloring maybe, because you have different colors.
Pink, blue.
Yeah.
We got to.
Okay.
Yeah.
So we've got to go buy all the ingredients. Okay. So what's happening there?
So we are spending cash.
Right, which that to spend and reduce our cash is a peanut. So we'll just say we spent $1,000. So we have peanutted our account.
Okay.
So that has reduced our cash, which is a credit. That's a peanut.
But this has to be...
So now we have to do something with our regular.
But so we're not going to add... Well, we are going to add assets because of our ingredients. They're ingredients.
Are they an asset? Sugar?
Yes. Yes.
Debatable.
Can you tell that? Okay.
Debatable.
What would you say?
Okay, so I guess you could keep them in inventory. It would be inventory is what it would be considered. That would be an asset. If you don't immediately expense it and you hold it in inventory, it's kind of like a work in progress thing,
well,
right?
Then let's say I'm buying it with the intention of within that week, I am turning that into product.
Well, even then, yeah, we'll call it inventory.
Okay.
Yeah, we'll just say it's inventory, but that means we have to track the inventory now. We've got to keep track of what we still have in stock and what we've used, right?
So if we weren't going to make it an asset, it would be
equity. An expense.
It would be an expense.
Which would, yes, ultimately be equity, and I'll explain that in a minute. But let's just say it's going to be inventory, which is an asset.
All right, so green, regular going in.
Yes, so that's an inventory asset.
All right.
All right, so then we make the cotton candy.
Yes.
All right.
So now our ingredients have become
a finished product. Right.
Yes.
And in accounting, you've got the raw ingredients and you've got the finished goods, which is just one asset to another, right?
Okay.
In accounting, you move it from raw materials to fixed or finished goods.
Okay.
Okay. All right. So, and you might have different SKUs. You might drill down on that, right? You might have blue cotton candy, red cotton candy, whatever you have, right? Mm-hmm. And that's now different SKUs that you're ready to sell, but it's all still an asset.
Yes.
Okay.
Okay. So we don't have to do anything.
No,
here.
No, I just was talking about it. Okay. We didn't actually put the M&Ms in, but all right.
Now, but what you're saying is if we wanted to get super, super technical and add more M&M colors and more cups, we would be moving things around.
Yes. I mean, it wouldn't be more cups because it's still just regular and peanut. It would still just be regular and peanut.
Yes.
We're just debiting and crediting different asset accounts.
Okay.
So Tesla, when they make a car, they're buying all the parts, right?
Yes.
So they have, and I don't know car parts, so I don't know why I picked this example, but wheels,
a fender and an engine, and
and I have no idea.
Yeah.
Does the engine already come assembled? Maybe even that they put together. I have no idea. Does it even have an engine, Teslas?
Yes, but they don't run on gas.
I don't even know. So
a
this
battery
is
then.
a horrible example for me to pick. But anyway, all these parts are coming to Tesla and they're forming it into a car, right? So throughout that process, when they first get those parts, they're in there differently than when the finished product is done. Mm-hmm. Okay, but they're both assets. The raw parts, raw materials, and the finished cars, both still assets. Does that make sense?
Yes.
Okay.
Yes.
All right. So we have our finished cotton candy.
Yeah.
Now what?
Well, I'm probably going to take the first package and test it. Because we've got to make sure we've got a good product, right?
Okay. So Chris eats one of our cotton candies.
Just one. Yes.
I think we're going to have to call that a distribution. An
Okay.
owner's distribution.
Okay. But it's not $1,000 or anything.
Either we call
so it's
it
not
shrinkage, right? Or we call it an owner's distribution.
No, I think that would be shrinkage. I think we're going with shrinkage on that one. Yeah.
All right. So what's happened? We have reduced our inventory by one cotton candy.
Yes.
Which, just for the sake of ease, we're just going to say that was $1,000.
Okay.
We have really
I ate
premium,
$1,000. Yes.
really premium cotton candy here. Okay. So we've reduced it by $1,000. So to reduce an asset, that's a peanut.
Okay.
And it's green because it's an asset.
Okay, so let's say we did just to make things easy, let's say we had like a soft opening at our...
We haven't even finished this transaction, so hold on.
No, that's what I'm saying. We're going to do this, and we'll just say we gave out $1,000 worth of... to make this easy, so that it doesn't look like I ate $1,000 worth of cotton candy. That's what I'm saying. I've changed it to where now we are giving it away, sampling to our community.
Okay. So at the end of the day, whether we call it shrinkage, maybe we call it advertising.
Yeah.
We could call it gifts, maybe, right? But at the end of the day, it's an expense.
Right.
That's ultimately how it's going to be coded. All right. All income and expenses filter into equity. Did you know that?
Wait, say that again?
All income and expenses filter into equity.
Why
funnel? Maybe funnel's a better word. Funnel into entity.
Why would an expense not be a liability?
No. Your income statement, which is your income and expenses, it all ultimately goes into equity.
Okay. So liabilities are things that I owe to somebody, not things that I've actually paid to somebody.
Well, and it could be both, because if you, for example, have an equipment loan that you used to buy something, that liability was for something you purchased. But the expense,
yes,
ultimately the expense goes to equity.
Okay. Yes.
So your income statement, profit and loss, if you will, that sheet, people are mostly familiar with that, right? It's got your income at the top, then it's got your expenses, and then your bottom line, your net income, right? That shows you if you made money during that period, right?
Yeah.
That net income bottom line goes to your balance sheet, and it shows up in the equity section.
Okay.
So if you make money, your equity goes up.
Yes.
If you lose money, your equity goes down.
Which makes sense, yes.
Right?
Yes.
So in your business, again, going back to the house analogy, it's kind of like the value of your house, right? As the value of your house goes up, your equity goes up. If the value of your house goes down, your equity goes down.
Right.
Same situation here. The value of your business goes up when you make money. The value of your business goes down when you lose money.
Okay.
Right?
Yes.
So all your income and expenses ultimately feed to your balance sheet, your equity.
Okay.
So in QuickBooks, which is what a lot of business owners have, it will show in the equity section on your balance sheet, it will show a net income line. And that's your current year income, whatever the bottom line is, whether it's positive or negative.
Yeah.
Hopefully it's positive.
Yes.
Then there's a retained earnings line. That retained earnings is all your cumulative profits from the beginning of your business until the end of last year, whether it's a positive or negative.
Right.
So if it's a positive, if you've made a cumulative profit over the years, even if you had some bad years mixed in there,
but overall,
over time, cumulatively, that's what retained earnings is all the profit you've made over time. So that's why I say income and expenses are really only temporary accounts. Did you know that? Ultimately, they go to retained earnings.
I did not know that.
Yeah. So income and expense accounts are temporary accounts. They ultimately go to retained
because they
earnings.
don't live there forever.
They don't live there forever, right?
Yeah.
You can always, it's basically like a drill down. If you ever think about a report where you click on a number to see the detail, your income statement is just clicking on your net income to see the detail.
Yeah. Okay.
But at the end of the day, it's a blue M&M. It's equity. Okay? So
Yeah.
all expenses and all income is going to be a blue M&M. Equity.
Okay. Yes.
Okay. So whether we call it shrinkage because you ate it, or we call it a gift because we gave it away, or maybe we decide we want to see it as advertising,
Right.
because we gave all this cotton candy away. It's a blue M&M. It's all expense. Okay, so we did a peanut M&M because
Yes.
we reduced our inventory.
So we have to do
Now
a
we have to
regular.
do a regular M&M, which, as I mentioned, is blue because it's equity. And I don't remember. Did I do one? I think I did
Just one, yes.
Okay. So now we have one blue M&M
Okay.
because we had to do an equity, regular equity on our journal.
Yes.
Okay.
And so that goes in as expense,
Yes.
as an expense.
Yes.
Okay.
Which ultimately either increases or in this case
Right.
decreases our equity.
Yes.
Okay. Now what?
So let's sell some.
Something. Okay.
Yes.
Now
Let's
we're
sell
out
some-
of inventory now because we gave away everything. But
So we'll pretend we made some more.
We'll just pretend like we bought some more raw materials, we made some more, and we already did all that. Okay, so now we're selling.
Yes.
So we have our inventory, which is an asset. We're giving people our inventory, and they are giving us money in return.
Yes.
So there's actually a few things that are going on there.
Okay. So we got to get rid of some green regular M&Ms
So
because we're losing.
well, we stopped doing it that way, remember? Because to reduce our bank account, we do peanuts.
That's right.
Yes.
That's right.
So
But then
we're not reducing our bank account in this case, we're reducing inventory.
So then why?
So let's think about that. First, we got to reduce our inventory. So that's a peanut, a green peanut.
So why does it? But we don't take out any regular M&Ms. Why don't we?
We're not taking out. But we still got to balance these. So I just did.
But why aren't we
peanut.
taking? So here's my question. So we are losing product.
Yes, which I just did by putting a peanut M&M green because
Okay.
we reduced our product.
So, but we don't have to take one out of our
No,
regular.
and I know
M&Ms.
it's weird. This is not a perfect analogy.
Okay.
I know. I
Okay.
get it.
Yes.
But I'm trying to hit home the fact that it's a peanut. We have to do a peanut to reduce our inventory.
Okay. So we put one in there, which means we've got to put another peanut in here.
Think of it like a caterpillar. You have a caterpillar
Yeah.
and it turns into a butterfly. In this case, our inventory, when we sold it, it turned into a peanut M&M. It was a regular M&M. Now it's a peanut M&M.
because we sold it.
Because yes. So we no longer have the inventory. It has moved on to
Yes.
its peanut M&M heaven. So it has moved
Yes.
from being a regular M&M. It's no
Okay.
longer a debit.
Yes.
Now it's a credit.
Gotcha. Okay.
It's no longer regular. It's now peanut M&M.
But we need to balance.
We still need to balance it.
And so
We're out of balance now.
you said all income is equity.
All income and expenses is equity. Yes.
So we made money.
Now this one's going to be a little more complicated because there's actually there's multiple accounts that we're actually affecting.
Okay.
Okay.
So to
So-
balance, but we need to put a blue.
So this is going to be a little confusing. So I'm going to
Okay.
try not to make it confusing.
Okay.
When you sell inventory, you're crediting your asset, which is your inventory. You're debiting your cost of goods sold, which is how it gets expensed. Cost of goods sold is an expense to the company. Okay?
Yes. Yeah.
Okay, so that's
Yeah.
how you handle the inventory side of that transaction. It goes from being an asset to an expense. So yes, you're going to do a blue regular. You were right about that. But that's
Okay.
the cost of goods sold. It's an expense. Does that make sense? Because now it's no longer an asset, it's an expense to the company. That's because we never expensed that material. The sugar, we had it as an asset. We never showed it as an expense.
Okay.
Now that we've sold it is when we show it as an expense. Does that make sense?
Yes.
Okay. So we should have went with a service company in this example probably because inventory companies are a little bit more complicated. So yes, we're going to do a regular blue M&M. That's our cost of goods sold.
Okay, so let me know if this is kind of a way to look at it. So instead of us saying we were going to have to expense that at some point.
Yes.
And instead of expensing it when we bought it,
we expense it when we sell it.
Right.
Yes.
Okay.
Exactly.
So I'm on the same page.
So that's the expense and the inventory side of it. Now we still have to address the sale.
Yes.
Right? Because they did give us money in exchange for this product. So there's actually 4 accounts that we're hitting in this transaction.
Okay.
So that was 2 of it.
Yeah.
That's one side of it, which is the inventory side of it. Now we're going to deal with the sale. So let's say they gave us cash in exchange for that money.
Yes.
Or for that cotton candy.
Right.
Okay. So what's happened there?
So cash is an asset.
Yes.
So that would regular green.
Yes.
Regular
it goes
M&M.
up. Yes.
Okay. And so now to balance, that is income.
Income.
So
yes.
it's equity.
Yes. Yes.
All income is equity.
It ultimately goes
so
to equity.
it's a peanut M&M
yes,
that's blue.
Yes. So you credit income accounts to
Okay.
increase the income, which is a peanut M&M. Yes. So in that transaction, there's actually 4 accounts that you have to book.
All right.
And that's for any inventory company. When you have to switch inventory to an expense, and then of course you still have to book the sale, that's how you have to do it. Yeah. Now service companies, that's obviously easier because you're not dealing with inventory, right? A bookkeeping company, for example. In my company, we don't have to worry about inventory. We don't do that. We provide a service. So I don't have to worry about tracking sugar and all this other stuff and then having to make sure it gets taken out of inventory and expense, right? I don't have all of that.
Yeah.
So it's a lot easier for a service company. And that's why some bookkeepers, by the way, will only provide services to service companies. I hear that a lot.
Because then you don't have to deal with that
Yes.
stupid plastic stick that goes on the end of the cotton candy.
Yes.
Okay.
Yes.
Got it.
And when
Got
you
it.
have inventory, you have to track it. So you have to count it and make sure what you show on your books is actually what you have in your warehouse or whatever.
Right.
Yeah.
Okay.
So it gets a lot more complicated. All right.
Wow.
So
All
we
right.
sold the cotton candy.
Yes.
Now what?
What would be next? I don't know. What do you think is next?
Well, we've got to file our taxes.
Gosh.
Now,
Okay.
I can provide the bookkeeping
Yes.
services, but I don't do taxes. So we got to hire someone to do our
Okay.
taxes.
Yes.
So we hire a professional to take care of that for us, but we got to pay them for their services.
Okay. Yes. That's
So
correct.
what happened?
So we lost. We had an expense.
We had an expense.
We had an expense.
Yes.
So that is a blue peanut.
No, because our expenses are going up, which is a debit, which is a regular.
Okay.
So
there's our
that's
expense.
a regular expense. Yes, it's a blue regular because it's ultimately going into equity, and we're increasing our expense, which is a debit. That's a regular.
So me paying for something would never go in as a peanut or a credit.
I wouldn't say that's very broad.
Okay. It depends.
Very broad. It depends.
Okay.
Yes.
All right.
It depends. All right. So now we've got to get our peanut. We need something in the peanut cup.
Yeah.
So we have the expense, which we put in, let's just say we put it in professional fees expense.
Okay. It's not an asset
No.
because we didn't get anything.
Well, what happened though?
We had our taxes filed.
Yes, the expense. So whenever you say it's not an asset,
That I don't have
we didn't
anything.
gain an
Yes.
asset is what I meant.
Right.
But actually you are affecting your asset account because you paid something from your asset account.
Right. So so it would be loss of
A loss of your asset.
Yes.
Yeah. So the asset account is affected.
Okay.
Your cash that you
Yes.
paid to that professional.
Yes.
So that's the peanut. It's a green peanut because you're
into a
the
green peanut.
Yes.
Okay.
Yes.
Okay.
Because your checking account, let's say you paid with your checking account, was reduced. So that's a
Gotcha.
green peanut.
Okay.
A credit
All right.
to your account.
Yes.
All right. So here is an instance where whenever you said earlier something you pay, I think this would be the contra to that.
Yes.
All right. So let's say we made a loan payment.
Okay.
We had our SBA loan.
Yep.
We paid off some of that loan. We made our monthly payment. Now, for this, I'll bring out the mini M&Ms. I brought mini M&Ms because sometimes you might have multiple accounts affected.
Oh, okay. All right. So
So-
we're going to have to put 2 of different colors into one cup
We'll
at
see.
the same time.
We will see.
Maybe.
Let's talk
Maybe.
through it.
All right.
We made a payment. So what
Yep.
happens to our account, our bank account?
It goes down.
It goes down.
Yep.
Which we just had this example. What does that mean?
So I put a green peanut.
Yes. Yes.
Okay.
Because peanut means a credit,
Yes.
and crediting a bank account reduces it. Okay. So we've reduced our bank account by that amount. Now, what's on the flip side? What is our regular M&M side to make it equal?
So we've got to put in 1 M&M. When we're dealing with a loan, that's a liability, right?
It's a liability. So we're reducing the liability because we're paying it down. But when you make a payment for a loan,
That's good.
well, I mean, that is not necessarily bad. I know some people think it is.
Right.
So
right.
I'm not going to
Okay.
make a judgment call and say
Yeah.
debt is bad, but I'm just saying you've reduced your liability,
Okay.
right?
Yes.
But if you make a payment to the bank for a loan, do they take the entire amount that you paid them and apply it all to your loan?
No,
No.
because you have interest.
Yes. So that's why I say we need the mini M&Ms
All right.
because we
Oh,
have to
no.
affect multiple things here.
I was just getting the hang of our 6 cups here.
So we've reduced the bank account. Let's just say we made $1,000 payment.
Yeah.
Now, just for the sake of ease of math here, let's just say 2 mini M&Ms equals 1 big one.
Sure.
We're going to go 500 and 500. 500 went to interest. 500 went to the
Wow.
principal of the loan.
Okay.
Okay? We're just doing easy math
Yes.
here.
Yes.
Okay. So we have 2 color M&Ms that are going to be affected here.
Okay.
That's
Yes.
why we have the minis.
Yes. Okay. So these have got to go. These are regular M&Ms.
Yes, they're
Going in
both
the
going to be
regular.
debits, so they're both regular M&Ms.
Okay. So one is liability,
Yes, so it's an orange M&M.
and that's because
So debiting a liability is reducing the liability.
Yes.
That's why it's a regular M&M.
okay, and I'm thinking a blue
Okay, and why do you think blue?
because it's an expense.
Yes, that's right. Look at you. You're getting
And
this.
that's because of the interest.
The interest is an expense, which
Yes.
ultimately feeds to equity, and that's why it's blue.
All right.
Yes.
Okay.
See? You're doing
No, I'm
this.
good with these. I'm good. I'm good. All right. I was a little worried about adding the minis, but I think I'm good.
So what happened there is on the credit side, which is the peanut M&Ms, we just
Yes.
had one account, right?
Okay.
That was the bank account. But on the debit side, the regular M&Ms, we had to split it.
Yes.
Okay?
Okay.
Now, this could be split in a lot of different ways. If you've ever seen journal entries, sometimes they get really long, lots of lines. This might happen, for example, a lot of times we have this situation when we're booking payroll entries.
Okay.
So the payroll company will take out in one lump sum everything, right? They'll pull out, maybe $50,000 out of the company bank account to cover all the payroll stuff. And so you have this one credit line item for the amount pulled out of the bank account, but you might have hundreds of expense accounts and tax liability accounts and things like that you're affecting on the debit side.
Yeah.
So it can get a lot more complicated.
Yes. Okay.
So just to give you an idea about how much fun accounting can get.
Wow. All right. I like it better when we're dealing with the M&Ms. Okay, so I know the next two things we need to do. Okay. We need to sell more cotton candy.
Okay.
So that's a green peanut.
So that's crediting your income. So yes.
And then
that's the income.
A blue regular.
For what's the flip side of that?
Because now we're charging it as an expense. That we're losing the...
Well, okay, so that was booking the income, right? The income
yes.
For selling the goods?
Yes.
Okay, so we should have gotten some money, right?
But I
From
thought
the customer?
But weren't we saying that we're charging it as an expense now?
That's on the inventory side. So remember, there's 4 parts to our sale. So you just book the income. So the flip side of that is we're bringing in some kind of money.
Okay, so then that would be an asset.
Yeah, we would increase our asset.
So this.
By the money that we get.
A green.
Yes.
All right.
Then you got to deal with the inventory adjustment, which is that you're reducing your inventory asset and you're increasing your expense.
Okay, so we'd put a green peanut for losing.
Let's see. Let me think about this. Yes, because we're crediting inventory,
and then a green regular for the cash that is coming into the business.
No, we already did that. We already did the cash.
A green.
No green. Blue, because it's the expense.
Right, we just did that. We made the money.
Yeah, we already did the money part.
Okay, this is because now we're losing this inventory.
We're losing the inventory, so we're booking the expense now.
Okay.
Yes.
All
yes, right. That's the 4 parts.
It gets a little confusing when you got to do the
4 parts.
The different parts.
Yes.
Okay.
This is why, like I said, a lot of bookkeepers will not deal with inventory companies.
Yeah.
It is more confusing.
Okay, so that was the first thing. Now, I need a company car.
Okay. Of course you do, because we've sold $1,000 of cotton candy, and we are rolling in it.
I need the car, and it's going to be painted with blue cotton candy on one side and pink cotton candy on the other.
This is going to be a highly profitable business.
It's a Hummer. I want this to be as noticeable as possible. Okay, it's all for the business. It's not for me. It's for the good of the business.
Oh boy!
So I need a company car.
Okay. Uh-huh.
And so
what's happening there?
One, we are losing.
Now, how are you paying for the car? Keeping in mind that we only have less than $10,000 of cash. That's what we started with.
It's an H2, like a used H2. So let's just say for the sake of ease, I'm getting this for like $5,000.
Okay, if you get a H2 for $5,000, then I'm in favor. Even though we've made no profit so far,
it's got like 150,000 miles on it, but we're gonna put that to the side because I need the company car.
Okay, but you still have to wrap it with all this advertising. That's not cheap.
And that's why I got the $5,000 car and not the $10,000 Hummer.
Okay, we got the $5,000 Hummer.
All right.
So what happened there?
So we lose $5,000 worth of assets because the cash is flowing out.
Which is
that's five.
That's a credit. So that is a peanut.
5 green peanuts.
Yes.
I think I grabbed 6. There we go. 1, 2, 3, 4, 5.
Okay.
So now to balance it,
we got to do something with regular M&Ms.
But now that would be an asset to the business.
Yes.
Because now we have the vehicle.
Yes.
So we're going to put 5 regular green M&Ms in.
Yes.
Okay.
Exactly. You're getting this.
I am getting this. There we go.
Now, just to take it next level, since you're feeling comfortable right now.
I'm feeling good. I got my Hummer. I am good to go. I am good to go.
Now, let's talk about depreciation. Because you got to depreciate that car. So let's think about this. Does that car stay? I mean, in this case, you got it well below its actual market value. But let's just say the market value was actually $5,000 when you got it.
Yeah.
what happens to a car when you start driving it?
The value goes down.
It goes down.
Yeah.
So is it fair to keep this, $5,000 Hummer on your books at $5,000
No.
after you've put 300,000 miles on it?
Yeah.
Okay. So, I think we all kind of understand the principle of depreciation. And I had Josh Dixon on a few episodes back, and all we talked about was depreciation. So I'm not going to get into the nuts and bolts of this. But the whole principle here for our M&M purposes is every year you have to depreciate some of that value, which means you have to expense at least some of that value.
Okay. So do we want to make it easy and just say... we're gonna... we've got our minis. So we'll just say $500 in depreciation.
Okay, sure.
So...
so you have the expense side, right? Which means you're taking some of the value of that car and you're expensing it. It's an expense. Depreciation expense.
So an expense is blue.
Yes, because it ultimately feeds to equity.
So we put a blue... in the credit.
Do we? If you're increasing
no, that would be a
expense,
debit.
It's a debit.
That would be a debit.
So it's a regular.
Okay, so but then we got to put 500 in the credits.
Yes.
To make it even.
Yes.
And so I'm losing $500 worth of assets, correct?
Yes.
So that would be
That is
green.
correct. It is green.
All right, so we'll throw that in there.
There we go.
All right. Okay.
So you did it. You did depreciation.
I depreciated.
So you depreciated $500 of that asset. So now on your assets, on this vehicle that you have on your assets, it's now only $4,500 of assets.
Right.
And $500 are expensed.
Yes.
So is this starting to help put the pieces in? Does this help?
Yes.
Okay.
Yes, it really does.
Okay.
I can safely say this is the best understanding of accounting I've had since 2010. Since I took my accounting class.
Perfect. See, your professor should have just used M&Ms.
Exactly. But okay, I will say this: the whole debit credit thing, and I really love the way you use peanuts or peanuts versus regular.
Yeah.
Because it makes you not say debit and credit.
Yes.
Which gets confusing.
It does.
I do remember now how big of a problem it was in that class. I mean, I'm sitting here as an adult and I'm struggling.
Yes.
And this poor woman had to teach, 25 high schoolers about debit and credits and how it works. And I remember that really being a big problem now that we talk about it.
Oh, it's huge. And I remember in my young 20s, just could not wrap around why we would be debiting an account to increase the account. It did not make any sense to me whatsoever, which is why I think if we just took those words out of the equation, it would make it so much easier.
Yes.
So regular M&Ms, peanut M&Ms, change your life.
Yes. And you have to have your debits equaling your credits.
Yes.
Because when you lose something, whether it's assets, whether you're like we did depreciating a car, or you're losing product that you've sold.
Well, it's not about really losing. It's thinking about it again with the house example. Your house value is fluctuating, right? Mm-hmm. Your mortgage is fluctuating. So the difference is always that pot called your equity. So it's not necessarily, when you think about it that way, the reason why everything has to balance is because whatever's left always goes in your equity. So you've got the assets, you've got the liability, and you've got the equity, and those always need, the asset equals the other two.
Yes.
Right? So ultimately, that's what you're balancing.
Okay. Right.
So you've got to make sure those assets always equal equity and liabilities.
Yes.
Right? And you do that by keeping your debits and credits always equal. Otherwise, you run into a situation where your books aren't balanced. Mm-hmm. Some flip side of your transaction didn't. Like, let's take any number of those transactions, any one of them that we did, right? Let's say we took the income and we recorded the income that somebody gave us cash. Mm-hmm. We recorded the income, but we didn't record the cash. Well, now our bank account balance is incorrect.
Yeah.
or let's say we recorded the cash, but we didn't record the income. Well, now our income isn't correctly affected. Like something, if your books aren't balanced, something didn't get recorded.
Yeah.
So hopefully that helped.
So let me ask one question real quick. So what's the danger of when you get down and you sit down at the end of the day and these things are not equal, something's out of balance? Is the danger then IRS or somebody comes knocking, or what's the real danger in not having your books balanced?
Well, as a business owner, a big thing is not being able to make right decisions because you really don't have an accurate view of what's going on in your business.
Yeah.
How can you really see if you're
Right.
making money? How can you see if you've priced things correctly?
Yeah. That's true.
So decision making is going to be skewed because you don't even know your numbers. But yes, IRS would be another issue because if you don't have things accurately recorded, how can you accurately file your taxes? You
Right.
can't.
Right.
And it could work in the IRS's favor, but then you've messed yourself up because you've overpaid your taxes. So either way, it's not a good situation. So yes, that's a factor too. Now, in today's day and age with software, there's so many accounting softwares out there now, including QuickBooks, which is probably the most popular one with small business owners. It doesn't let you have an unbalanced.
Oh.
You
Okay.
can't.
Yeah.
It will physically not let you. It will give
Yeah.
you an error message if you try to create a journal entry or some kind of transaction and you're only recording one side, or you've recorded both debits and credits, but they don't equal each other. It will give you an error message and tell you you must balance. So software these days doesn't let you even save anything unless it's balanced.
Yeah. Okay.
So it's a lot easier now that software has been invented to
Yeah.
fix this. But can you imagine the days when they actually had to physically
Oh my
write it
gosh.
out?
Yeah.
I mean, can you imagine? And if you have thousands of transactions in your business going on, trying to figure out where you forgot to put something or did a typo or something, what a nightmare that would have been to have to go back and look through your notes and figure out where it went wrong. I can't even imagine. I'm so glad I'm born in the age of software.
Well, it seems easy to me. You just make a footnote, right? Or what did
Footnote.
what was it? I was trying to think. I couldn't remember what was
the journal entry?
Yeah, just make a journal
Just
entry.
make a journal
Yeah.
entry.
That's how I would have done it.
But you still have to equal. So if you're doing a journal entry.
No, I think our man's onto something here. I think he's onto something.
Journal entry. So, all right. Hopefully this has been helpful to everyone. If somebody wants to do podcasting, how can they find you?
Yeah. And hey, I encourage food, bringing
Yes.
food in. You can check us out, freedonation.live, or email me. That's the easiest way to get in touch with me, Chris, Kris, at freedonation.live. What about you, Lindsay?
I'm Lindsay Kline with Kline. If anyone needs help with bookkeeping, we are here for you, and we can break it down for you, even using M&Ms if you need help understanding any accounting concepts. Find us at info@sakline.com, or our website is sakline.com, sakline.com. We are here for you, and thank you so much for joining us today. We really appreciate all of the support. Until next time, have a great week, everyone.
By the Books is presented by Kline. Honest, accurate bookkeeping performed on time. For more information on Kline services or to get a hold of Lindsay, visit sakline.com or email info@sakline.com.
The information provided on this website and podcast does not and is not intended to constitute legal advice. Instead, all information, content, and materials available are for general information purposes only. Information provided by Kline may not constitute the most up-to-date legal or other information. Listeners should contact their attorney to obtain advice with respect to any particular legal matter and should refrain from acting on the basis of this information without first seeking legal advice from counsel in the relevant jurisdiction. Only your individual attorney can provide assurances that the information contained herein and your interpretation of it is applicable or appropriate to your particular situation.
And then look, here's our business taking off. Woo! Selling all this cotton candy.
I hope you guys like M&Ms.
The cotton candy business is good.